Welcome back, ladies and gentlemen. My name is Joshua Castillo, and if you're checking out the channel for the first time, we focus on value investing, investing for the long term, buying undervalued companies, holding them for a long time. So if that's what you're interested in, make sure to hit the subscribe button, as well as like the video if this is something you enjoy. With that being said, because it would help the channel out a lot, let's dive right into what we're going to be looking at today. We're going to be taking a look at Q3 2022 earnings for ticker symbol RVLV. That's going to be Revolve Group. I'm very excited about this company. I sold puts on this company. If you want to see, click on the playlist wherever it's going to pop up. Click on that if you want to see more of my interest in this company. But we're just going to take a look at the quarterly earnings, go through it, talk through it, see what I like, see what I don't like, see what I think can improve. Let's dive right into this. As always, we're going to be using my girlfriend's iPad. You can't see, my dog is dressed up for a little Christmas time, but we're going to be using the girlfriend's iPad and as a way to go through this because I don't memorize all this stuff. So first things first that they wanted to mention, we delivered another profitable quarter with double-digit growth in net sales in the third quarter of 2022, despite the increasingly challenged macro environment, said co-founder and co-CEO Mike. Furthermore, we generated meaningful growth in our cash flow year over year, further bolstering our already strong balance sheet. With our profitable business model and strong balance sheet, we're excited about our continued investments in our brand and technology that we believe will enable us to capture future market share in pursuit of our very large global marketing opportunity. So first things first, some of these things I'm going to try to cut out or just glance over. In this case, I'm probably going to mention net sales and some of this stuff a couple of times, but I'll just look at it here and then glance over it later. So net sales, 268 million versus 244 million for the last 3 months. Ended September 30th, so that's a 10% year-over-year change. Gross profit only up $142 million versus $134 million last quarter. That's a 6% increase. Not a great thing. Kind of see it later where that all came from. Gross margin just above 50% still. It's awesome. It did tick down a little bit, as you obviously would imagine, with the difference in growth rates. Net income down 28%. Not really that surprising, and I'll go through that in a little bit. The other thing I wanted to mention was free cash flow. So free cash flow is up pretty big this quarter, and just over the last couple of quarters, it's been pretty big. And so I'll kind of dive into that in a little bit. The other thing I want to mention, operational metrics. So this is the trailing 12 months. They've had 2.249 million. They've had 1.6 million in the last year in 2021. It's a 34% increase. Again, that's trailing 12 months. Total orders placed 1.9 million versus 1.8 million last year. It's 7% increase. Average order value $320 versus $276. That's a 16% increase. These operational metrics are something that they touch on in their investor presentation over and over again. So I'll kind of dive into that in a little bit. So going through the rest of the metrics and commentary and things like that. So active customers, so they increased it by 84,000 during third quarter 2022. They grew it again to 2.2 million as of September 30th, 2022. Total net sales, 2.68 million. Gross profit, 142 million. Gross margins, so some of this stuff I highlighted in green, some I highlighted in yellow, some I highlighted in red. Yellow is just like a so-so. But really wanted to note it was a decrease of 211 basis points year over year, so that's 2.11 percentage points year over year. That primarily reflects a lower mix of net sales at full price in the third quarter of 2022. So really what that means is, again, selling things at the full price, so selling products at the full price, which last year they did a lot of that. I don't even really think they had many sales, if any, or things that got marked down as far as a sale. The other thing is our effective tax rate. It was in 2021, it was 14%, and they're seeing that, absent of all the tax items that they did have in 2021, they expect their tax rate to be around 25%. So almost a 15 percentage point increase, or really 11 percentage point increase, which is quite a bit when you look at what the effect on that tax actually was year over year. So net income, again, was $12 million, a year-over-year decrease of 28%, comparison that was impacted by meaningful differences in our effective tax rate. They mentioned it there. Lower gross margin referenced above, an increase in OpEx. So that's slightly outpaced the growth year over year. So again, not really too surprising. Again, you'll see adjusted EBITDA and diluted EPS came down just a tad bit. The other thing is, so their segments are Revolve and Forward. Revolve is kind of their luxury brand, and Forward's kind of like their really high-end luxury brand. So Revolve segment net sales were 222 million, it's an increase of 9%. Forward was 46 million, increase of 17% year over year. Domestic net sales increased 10% year over year, and international increased 12%. And they don't have like a lot of the Asian countries are still being locked down. So a lot of this has to do with Europe as well as some of the other North American countries and other countries outside of North America. But a lot of it comes from Europe as well as some of the other North American countries. The other thing that I wanted to add, so their cash and cash equivalents, and when we go through the balance sheet, you'll see it too. The cash and cash equivalents grew from 244 million, an increase of 22.4 million or 10% from September 30th, 2021, and an increase of 6.2 million from June 30th, 2022. So their balance sheet is debt-free still. The only thing that they're really having is, any sort of leases that they need to do for their warehouses, for their different offices that they have. And the other thing too is that they are trying to decrease actively their inventory. So their inventory as of September 30th, 2022 was 213 million, an increase of 4 million or 2% from June 30th, 2022, an increase of 71.6 million year over year or 50% from the inventory balance of 2021. We've taken swift action to balance our inventory levels given the moderation of consumer discretionary spending in the current economic climate. And again, they kind of ask questions later to the analysts, but let's just take a quick look at the, net income statement, balance sheet, statement of cash flows. So really what I'm going to focus on, since I already touched on a lot of things on the net income statement, is I actually want to focus on the different operating expenses that they have and what this actually means. So first things first, the fulfillment's up nearly half. And again, that's because of the freight rates, people returning things and things like that. Their selling distribution, $46 million. That's really going to be like the logistical part of the business. So the fulfillment's really going to be, the different items, and then selling distribution is going to be like getting it there and delivering it. The marketing is down slightly, and again, they kind of mentioned why it's important that its marketing is down slightly. They've seemed to be doing a lot more with a little bit less. So that's what they're starting to realize as they, have come into 2022 guns blazing. General and marketing, or general and administrative, is up slightly. And then again, the provisions for income tax. So this is kind of what I wanted to point out with the income tax change, is that's almost a double because of the income tax rate. So that is something you want to pay attention to, because that's a pretty big change in income taxes. They didn't have the tax items that they did last time. So to see that nearly almost double is kind of scary. But again, this is going to be their normal tax rate, so not really too surprising there. Hopping on over to their balance sheet, just some quick things I wanted to mention. As they had already mentioned earlier, cash and cash equivalents along with inventory. They do have some more over in AR. Other than that, not anything too crazy. Not a crazy quarter, at least. Their current lease liabilities are only up a couple million, if that. It's almost 2 million. So not anything too crazy there. The other thing I wanted to mention too is look at those return reserves. So they went from 49 million in December 31st, 2021 to 72 million in September 30th, 2022. So that's something I want to mention too. And along with the fact that, they're going to have to make sure that they don't incur too many returns. It seems like they said that their returns were a little bit above average. The other thing I wanted to mention was going on to their cash flow statement. So this is for the 9 months ended September 30th, 2022. So the numbers look a little wonky compared to the stuff we compared before. That's because this is 3 quarters instead of just one individual quarter. So the thing that I really wanted to focus on was their equity-based compensation. This has consistently gone up, year after year. And, again, as long as a company is growing, it's fine, because a lot of it's tied to this. And really, both the CEOs, Mike and Mike, actually, they own a lot of the company. I think it's close to 50%, if not 50% of the company. So a lot of this equity-based compensation isn't necessarily going to them. A lot of their stuff is tied to like stock awards and things like that as they hit different milestones. But I do like to see, again, their purchase of property and equipment. So that's up just a tiny bit as well. So, they're making free cash flow, which is great, but they need to focus on making sure that they keep that free cash flow generation up while staying profitable and things like that. And if a lot of that PPE or property and plant and equipment, If a lot of that's going towards maintaining the business, that's awesome. If it's being, wasted on like an R&D type of item that they're doing, then maybe it might not be worth it in this environment currently. So moving on though from that, I wanted to touch on their segments as I had mentioned earlier, kind of touched on it. But taking a look at their net sales, so their net sales for Revolve was 222 million. Again, Forward was 46 million. For the 9 months, though, look at that. 9 months, 704 million for Revolve versus 545 million in 2021. Along with Forward, that is 137 million versus 106 million in 2021. So that's really awesome to see. Their gross profits also up just a tad bit from last year, which is awesome. And it really speaks to the company about being able to open up for events and running these events and being able to use different sorts of social media influencers to be able to push the brand forward and be able to actually market it. And looking at the geography of where they're actually selling these products, as I mentioned earlier, everything's kind of starting to open back up, so they're starting to benefit from that a lot. The United States, 217 million versus 198 million last year, along with, if you look at the 9 months, 696 million versus 527 million. The rest of the world, so the rest of the world is 51.1 million, along with, last year at 45.5 million, and then the 9 months is 145 million versus 124 million. So some growth there and some things you want to see. And then they just obviously had some of the operational metrics that we had already kind of gone over and touched on. So I don't need to go over that again. The free cash flow, this is how they calculate their free cash flow. So it doesn't take into consideration stock-based compensation like I know a lot of people do. But I don't personally look at it necessarily that way, but this is how I would calculate it. So they just took their net cash provided by operating activities, then subtracted out the PPE. So again, their free cash flow for the quarter is 8.6 million, and then for the 9 months was 30 million. Last year, I think it capped out at around 60, 70 million for the full year 2021. So when we go into Q4, or we're technically already in it, but when we go into Q4's earnings, it'll be interesting to see what the year actually capped out at and see where we land on the free cash flow. 2020 and 2021, a lot of people got stimulus. A lot of people had a lot of excess money because they weren't going anywhere. So they had money to spend. So it'll be interesting to see where that free cash flow actually normalizes going forward. Now we kind of like come back to a little bit more of a normal time. Now moving on, net sales. So this is going to be taking a look at, what part of their inventory and what it all makes up percentage-wise. So I'm just going to touch on the numbers, and you can look below if you want to see what percent of the net sales was actually for each category. So fashion apparel, not really that surprising that it's down a tiny bit. As people have been able to buy more dresses, as people have been, not paying as much into the fashion apparel, not really that surprising. So it's 118 million versus 120 million last year. Dresses was 83 million versus 70 million last year, and dresses is where they make a lot of their margin. I think it's one of the higher margin items that they have. So to be able to sell more dresses and a little bit less fashion apparel, I think that management will take that. Handbags, shoes, and accessories up just a tiny bit, 56 million versus 44 million last year. Beauty is obviously up just a tad bit, 7.4 million versus 6.9 million. And then their other is kind of made up just kind of like a bunch of other different products that they have is 2.1 million pretty much versus 1.47 million. So again, if you look at the 9 months, if you look at the percentages, dresses becoming more and more, impactful on the, the balance sheet and the statements and things like that. They're going to earn a lot more money on these dresses, and because a lot of the sales are coming back for dresses and the demographics there and things like that, and events are coming back, they're actually able to sell more dresses. So you can see on the 9 months where that actually, what that actually looks like. And again, this quarter was down for fashion apparel, but the actual fashion apparel overall versus 2021 and 2022, that 9 months number is up slightly. So you'll see benefits as we move forward into next year and the years after that of dresses becoming more apparent as the events sort of come live again, because there wasn't really any events at the beginning of 2022. It kind of all kicked off in the Q2, Q3. That seems to be where they have a lot of their sales anyways. So that's very exciting. So one thing I wanted to note along with talking about that was the fact that they had touched on, and I mean, if you go through their reports, if you go through their transcripts, you go through their call, whatever you go through, a lot of what they touched on was inventory management because of what happened last quarter. So last quarter, they had mentioned, how badly their inventory was managed. Not really badly, but just, where they were at with their inventory and what they actually believed. And so this is what they wanted to mention with inventory. So they said, in response in 2020, we significantly reduced our inventory receipts by canceling or delaying orders. With consumer demand trends improving beginning in the second quarter of 2020, continue to improve through 2021, the first quarter of 2022, we invested heavily in inventory to meet the robust demand. However, during the second and third quarters of 2022, consumer demand trended down significantly, resulting in a significant increase in our inventory balance. We have taken swift action in our efforts to balance our inventory levels with the shift in demand, but we may not be able to respond quickly enough to adjust our inventory position accordingly, which may have an adverse impact on our operating results. So again, inventory, it's kind of been the name of the game across the board, as you've probably seen with a lot of other companies. So going along the operational highlights and some of the things I wanted to mention, because this kind of showed it a little bit better than I think what we saw, on the other pieces. So this is from their investor presentation, and just going through this really quickly. So their active customers, look at that growth from Q3 2018 to Q3 2022. It's a little bit over a double. They were able to pretty much 2x what they had, and then obviously a 34% year-over-year increase on Q3, which is awesome to see. That's gonna be trailing 12 months, Jesus. So the quarter-over-quarter growth is awesome. The total orders placed, again, look at Q3 2018 versus Q3 2022, nearly almost a double and, some change, which is awesome. And I think the big thing in all of this is seeing that the company has been growing and it continues to grow. Granted, it's not going to be at a crazy rapid pace like you saw in 2020 and 2021, but that's also because a lot of demand got pulled forward for product. The average order value is up, which is great. I do know that they didn't mark down as many things in Q3. They might have to mark down some things for the Christmas time / Thanksgiving / sort of holiday gifts and Black Friday and things like that. But we'll see some news as they kind of come out with it. Going to the cash flow highlights, so again, you can kind of see the differences between the last couple of years. So looking at the free cash flow, looking at that growth is kind of crazy. So you can see in 2020 and 2021, those are kind of abnormal. They shut down a lot of the expenses and things that they had because they weren't running events. So looking at Q3 2022 versus Q21 or 2020, it's not really like a fair comparison. I feel like in general, Q3 2022 is probably more comparable to 2019, which is why they include it. They also kind of mention it as they go through different things. They mention it a lot. They compare it to 2019. So, and then the last thing I wanted to show you was the cash and cash equivalents. So from 2019 to Q3 2022, they have done a fantastic job of keeping cash on the balance sheet, not taking on any debt. The only time they took on debt was when COVID first broke out in March 2020, and they really had to just, take a line of credit. They stopped taking salary and things like that. And that's kind of why I like this management team a lot. So focusing back on their earnings call and kind of going through it, I'm going to try my best to keep the names there if I can, but in some cases, I might not do a good job of it, and I'm very sorry ahead of time. But he's, Mike Karen, so I'm just going to use their first couple of letters. Mike Karen, shifting gears to net sales performance by geography, our U.S. net sales increased 10%, international sales grew 12%. The international results are impressive considering the significant appreciation of the U.S. dollar during the third quarter, particularly against the British pound and euro. These currency movements present a headwind to demand considering that our pricing is local currencies is tied to the US dollar. In other words, when the dollar strengthens against the British pound, our product becomes relatively more expensive for customers living in the UK, and we can clearly see the negative impact on our monthly sales results in affected regions. Our net sales results in Europe and the UK went from high single digits year-over-year growth during the month of July to negative year-over-year growth comparisons in net sales for the month of September, coinciding with currency exchange rates becoming much more challenging later in the quarter. So this is something I wanted to mention, and I kind of mentioned it with every other company I've been looking at, but the foreign exchange rate messing with everyone's business is kind of a big deal. And I don't think people pay attention to it enough and really seeing what kind of impact it has. Because when we talked about Dropbox, we talked about Meta, they all were impacted by it, and so many other companies are, because they do a lot of business where, you know, they're selling in the United States dollar, but people are buying in pounds, people are buying in euros, or whatever currency they're buying in. They're buying in these other currencies, and as the US keeps appreciating their dollar against those currencies, it becomes more and more expensive for people to buy things in their own currency. So that is something I wanted to mention because I felt like it was really important. So Michael Mente went on to say, so one nascent area of four, and again, this is all from Seeking Alpha, so if some of the letters and wording doesn't make any sense because of Seeking Alpha, not me, I promise. One nascent area of forwards growth that we view as exciting new opportunities, resale. So last quarter, we talked about our new forward buyback program, or proprietary resale program dedicated to circular luxury shopping, where we are offering to repurchase handbags from forward customers in exchange for credit on our site. This exciting repurchase initiative has opened up a brand new opportunity in resale for the first time, enables us to attract and retain customers interested in purchasing pre-owned bags within a new and dedicated section of our forward site called Forward Renew. I'm thrilled to share that this customer interest in pre-owned bags in the early going has exceeded our expectations. To build on our success, we are investing further to expand the Forward Renew program beyond supply from our own customers participating in the Forward Buyback program. In the coming weeks, we will begin testing the resale of handbags sourced from third parties with access to pre-owned handbags, including the world's most coveted luxury brands. So this is kind of an interesting change that we're seeing, is that, you know, they're trying to, you know, open up new opportunities for, you know, where people want things, but they don't want to buy a Gucci or Louis Vuitton bag for full price because they're okay with owning a pre-owned bag, especially if you're gonna buy like a luxury handbag and someone's taking care of it. It's kind of worth it to just buy it at the pre-owned price if it's in good condition, because, you know, a lot of this stuff, it's, you know, you're not like beating up a Louis Vuitton bag. You're probably taking it with you places, but you're not like taking it to a softball game, although there's probably people who use Louis Vuitton bags as softball bags. But you know what I mean, that there's not like these crazy things that people are doing with these bags. So there may be an opportunity there to resell things that are actually in good condition and actually get people what the products that they want, not necessarily just what you can offer, but giving people a chance to sell things as well. So Michael Benetti, and so this is kind of where the questions and answering piece comes from. So Michael Benetti said, thanks for all the details. Jesse, can you unpack, and Jesse Timmerman's CFO. So Jesse, can you unpack the 3% in October? Please, a little bit of a deceleration in the multi-year rate, just what's going on in the ground that you're seeing that you want to isolate for us to help us think about the trends in the quarter. And then I'm just trying to think about customer growth versus order growth a little bit. I know customers trailing 12-month number, but 34%, we can make some inferences there in the quarter. Can you help us understand the growth rate versus orders up 7% in the quarter? And I'm wondering if you're seeing a new customer that you think is going to require some level of discounting going forward or anything like that, just the given that I don't expect the customer growth rate to be as strong given some of the dynamics of last quarter. So Jesse says, yes, a few things here, I guess maybe starting from the back and working in reverse. So the active customers again is a trailing 12-month number. We're picking up the benefit of a couple of really strong quarters, especially Q1 of 2022. So we do expect that rate of growth to moderate in Q4 and then especially into Q1. So that 34% will come down. Again, these things will start to converge as things normalize. Hopefully you get some kind of normal here soon and get out of these crazy comps. Then the order side, the order versus dollar is an active customer. We're seeing that increase in average order value, and that's a combination of inflation price increases in that kind of mid to high single digit range, but also her shifting to higher price point products. And then also, like Michael mentioned, those higher price point products will get better than the lower price point products, and you can see that in the forward results. And then also within Revolve, you can see dresses checking really well. And then within some of the other categories, handbags and shoes doing really well. Within the fashion apparel category, some of those higher price points doing better relative to the lower price point category. So a lot of dynamics play on that front. And then in trends in Q3 as we enter Q4, so as we mentioned, July was plus 10. The comps got harder. We closed the quarter at plus 10. So it's pretty linear through the quarter despite some more tough comps in August and September, and also international getting progressively more challenging with the currency movements within the quarter. And that led into Q4, and we continue to see currency and international pressure. So domestic outperforming international in the fourth quarter, but October was softer than what we experienced in Q3 when you look at 1 year and multi-year comparatives. So again, interesting to see kind of what they're calling out on the financials. The average order value going up is a good sign for the company, but they need more people ordering. They need like more orders placed, so that way it keeps up with this sort of customers that they've had. And really what he's trying to get at is, are we seeing a tick down in the amount of things getting ordered because customers are kind of running off? You're getting like one-time buyers, or are you actually getting new customers that are staying and repeating? And so that's something I think that he's trying to get at, which I think he did a pretty fair job of answering that. And then lastly, so Matthew Coranda said, "Hey guys, thanks. How would you characterize the sort of number and depth of promotions on both sides relative to pre-pandemic levels?" And then I have a follow-up. So we're not going to have the follow-up in here, but just sort of, I just want to touch on the promotions. So he said, yes, so I think it depends on what kind of period you're looking at. But Jesse, to your earlier point, full price sales mix is still and is all very healthy and higher than pre-pandemic levels. Revolve, as we talked about, we think we have a better ability to manage through that inventory without taking significant levels of markdown. And then forward is a little bit more subject to competitive pressures and whatnot. So certainly our markdowns are elevated. I think that versus what we would consider a normal economic environment and on a go-forward basis. Our markdowns are elevated versus what we'd like to be, but we think that we'll have a couple quarters to work through. Then we expect to see that margin bounce back to close to where we were in the kind of the pandemic high periods, but certainly not quite there because that was a unique period. So that's going to pretty much end my look into the Q3 earnings 2022 for Revolve. Sort of the overarching thing that I wanted to see was, what are they doing about the inventory? What in the world are you doing about the inventory? You're going to address it. And if you read through a lot of their different items, they really touch on that a lot. The other thing that I want to mention that I actually didn't have here in the notes was they're actually working on partnering with a gaming sort of mobile game developer, and trying to create sort of their own, I guess, online experience, because as they mentioned in the earnings call, 49% of mobile gamers are women and their target market is women. So they're trying to get people into that flywheel to be able to buy products, or at least be reminded that Revolve is around the corner and it's there for you and things like that. So that's something I wanted to mention as well. I think the opportunity is there. The free cash flow is starting to normalize a little bit more. Granted, it is higher than in 2019, but as we kind of work through these inventory changes and as they are able to slim down their inventory and actually lean it out a little bit more, I think that they'll be able to benefit from that because they don't have to mark things down as much on Revolve. And, as we see sort of the economic pressures from the individual consumers, we'll have to keep track of that, and I'll let you know if I see any sort of big changes that might impact Revolve. And with that being said, have a great day and happy investing.